Welcome to today's info session, where we are going to be presenting a US dollar income note issued by Societe Generale. This note has a target return of 16% per annum, which would be paid out quarterly. It also includes various protection features, which we're going to be running through. For those who are new to the call this afternoon, my name is Jill, and with us tonight we have Andrew, and I think Logan is on board as well. Chad is at 30,000 feet on his way to Vietnam, so he's not going to be joining us this evening. For those of you who are going to be in Nelspruit, Andrew and I are going to be heading there tomorrow, and we're going to actually be co-hosting an event with good friends of ours from Aquarian and Reagan Van Roy. And it's quite an interesting title for the event. It's Beyond Borders, How to Reduce Tax and Keep Profits Offshore. So if you are in the area, head out to the Kruger for a couple of days, come visit us on Thursday. Please feel free to post questions in the chat as we go along so that we can actually answer everything before we leave tonight. And for those who are new to structured notes and have any other questions just in general about structured notes, let us know and then we will set up a time to chat. So with that, first some housekeeping as always. A reminder that we don't offer financial advice. The session is to introduce you to this particular structured note opportunity and explain how it works. We always encourage investors to do their own research before making any kind of a decision. Our full disclosure is available on the website, where you'll also find more information on structured notes, as well as our active and matured products if you want to have a look at a bit of our track record. So with that, I'm going to hand over to Andrew.
Thanks very much. Hi, everybody. Wow, this has been a very interesting last probably 72 hours for me. When we decided last week that we were going to participate in the raise of this particular note, generally what we do is we put together a rationale, which is the high-level overview of why does it fit in and does it resonate with current conditions, are there opportunities, etc., etc. So to try and nitpick and work out the actual dynamics and the DNA of the product at a granular level, and then we come to the presentation. Well, I've had to change the presentation about 3 times because in the space of literally, certainly the last 48 hours, markets have really been chucked around all over the place. And we're gonna spend quite a bit of time on that, looking at it. This particular note, we've actually been invited into. And in as much as what I mean by that is that we didn't go to Societe Generale saying we wanted a 16% income note. A lot of our clients are always looking for income, and the structurers in the bank have actually launched this. So they said, look, we can give you capacity. You can invite your clients in, show it to them, and if they're happy, they can participate. So we've looked at it, and it's a very interesting time because the actual positioning of this note can literally be placed in some classical sort of buying opportunities, and also with the risk associated with those buying opportunities. And we're going to deal with this. The rationale this time, we went back and we rejigged it because things have moved so quickly with pricing and what's been happening in world stock markets, and specifically out of the United States. We've rather dealt with the rationale at a higher level in terms of what are the trends, where's tech, etc., because this is a technology note. You can see it from the notice there. It's an income. It's got a knockout. We're going to go through those features. It's producing 16%, and it's got quite a short runway. 19th of March, we have to have our cleared funds and our dealing instructions through. Now, it departs a little bit from where we've been coming in the last probably 3 to 4 issuances, where we've had a very successful raise on banks. We've had a number of very successful banks notes that have been produced and oversubscribed. So this is a little bit out of kilter with our trend of being more defensive in terms of how we anticipated things would come. And as I said, we've been invited in. So there are certain clients who might want to sort of, if I can be polite, sit on the fence and watch what unravels in the next few weeks. And it might take you past the 19th of March. But it's certainly something to consider in terms of where it would fit into your portfolio. And is it an appropriate time for you to do the necessary work and ascertain whether it's a note that fits within your portfolio. So let's move into it. It's a technology note. What I mean by that, it's based on 4 major technology stocks. These are old friends of ours. They've served us very well in the past. Societe Generale, which is the issuing bank, in other words, they underwrite the actual debt issuance, are a tier 1 A-rated, globally systemic important bank. In other words, if something had to happen to them, basically the EU and the ECB and other central banks would need to basically do something and assist them. Yeah, they're a global bank and very, very important. The names of the companies there, we've got a bit of the stars and stripes coming through there because these are essentially, in as much as they are global companies with global revenue streams, their profits are reported in the United States after all is said and done. And they're affected minutely now by the legislation and the changing sort of economic landscape that is the US and its global relations with its trading partners around the world. Now, these are, that's the United States at a sovereign level. These are corporations. These are publicly held companies. So they are exposed to pension funds, hedge funds, ETFs, the man in the street like you and I, you name it. These are companies that pretty much you find in most blue chip portfolios. So these are quality names. And within those names, there are different, I would suggest, different levels of risk that get ascribed to those companies. So what I've decided to do a little bit in terms of not telling, there's so much noise at the moment. Joel brought a very good point. I did something at the beginning of the year called 7 lessons that I learned during 2024. One of them is to try and take out some of that noise through, whether it be social media, whether it be through webinars, whether it be, there's just so much coming at us in terms of what is happening, and it's moving very quickly. Particularly since the 21st or 20th of January, when Donald Trump actually took over and started almost on the same day with these so-called executive orders, rattling cages economically and politically and old alliances. And, there's nothing that's pretty much sacrosanct. Everything is pretty much fair game. So there's a lot of noise going on, and there's a lot of action, and there's a lot of nervousness and uncertainty. But therein lies opportunity. If it makes sense to a particular investor. So in the rationale, we'll deal with that. This is more granular, and I've actually gone to quite a big level of depth in terms of trying to educate and assist you in seeing how these companies do get moved very quickly. What is important in terms of when you do your due diligence and analyzing, is it the right time? Am I getting this huge discount that everybody said it's there? Is it like 2020? Where markets were absolutely on their knees and people who bought it, sort of from March to August did very, very well later on. Are we approaching that situation? A client asked me this afternoon, what's the difference between a pullback and a correction? He says, everybody's talking about a pullback. I said, well, in some instances, and you'll see some of I've updated this as of last night. I could do it now because the American markets opened, a short while ago, 15, 20 minutes ago. And there's been absolute carnage on the market, so they're not enjoying what they're seeing in terms of this tariff thing, and we'll deal with that. But no, a pullback is generally regarded as roughly 5 to 10%, and a correction is sort of 10 up to 20%. So some of those companies are now approaching correction levels, and we look at the quality of those companies, and I think that's what we've got to focus on. Is these are global names. I didn't mention simply they're in everybody's portfolio, or the Sage portfolios, I call them, simply because they're darlings. They're well-run businesses. And we need to understand, are those businesses, are these businesses being affected by reason of global influences, or have they got internal problems, which is a different situation. So let's have a look at the next slide. If we can move on to that one. Okay, here we go. So let's just review. Let's look in the rearview mirror a little bit. So 2023 and 2024, we've sort of got the gloating investor on the top right-hand side, nicely generated by AI. And you can see there the S&P and the NASDAQ, and I've utilized them in both years, did very well, 20% plus in S&P both years. And the NASDAQ, 55% in 23 and over 20%, nearly 30% last year. And there's a little drop-down arrow, the so-called Magnificent Seven, which are the 7 large tech companies. So tech is driven, and in fact, the markets have been driven by these 7 companies. It's very narrow, very concentrated, and the weightings that they have within those indices is so huge that when they do well, the whole index does well. Conversely, if something happens to them, there's a blip or a bump in the road, the whole index, both those indices will feel it. So 2023, 2024, and 2025 is big question marks, because you can see pretty much the bullet points there, which are basically outlining the challenges, both present and looking ahead. Now, certainly in the run-up to the election in the United States towards the end of last year, the Republicans and Donald Trump made themselves as, we are transactional leaders, we will get the business done, we will make business great again, America great, economies great, etc. They work on this word transactional decisiveness. And markets loved it. If you look at some of those companies that we've mentioned, they had fantastic quarter fours in terms of the last 3 months of 2024. It's traditionally a strong sector of the year, a strong quarter in terms of it falls over Thanksgiving, Cyber Monday, Black Friday, Christmas, etc. So a lot of spending gets done. And those companies all have had pretty stellar results that they reported. The quarter four reports of 2024 have come out during the first couple of months of this year. Haven't always been, they've also given lower guidance in terms of what's going to happen in 25, because 24 was great, but now what are they saying for 25? They've been a little bit muted, and in some instances they've been punished by the market, as we call it. So these are the threats. So the first 2 months, up until probably the 19th, I can call it actually the 19th of February. And I know that date because we've all got caught up in this noise. But on the 19th of February, the S&P and the NDX, the NASDAQ, hit their all-time highs ever. So it's only 2.5 weeks ago, those indices were at all-time highs. There they are, okay? And you can see it as you travel towards the right-hand side of those two side-by-side screens, which are simply just off my Apple. Very simple, but you can see it. Sharp declines since that period. And that's essentially when the tariffs that had been put on hold, suddenly the lids were taken off and things started to boil again. And it's become, I'm not talking about Ukraine and geopolitical stresses, those are still there. What is happening to the markets now is more economically and fundamentally business driven, okay, in terms of what is affecting them. Can we just, thanks for sharing that. Can we just go back to that previous slide with the bullet points? Because I'd like to address one or two of those. So the new US administration, I mean, the markets took off like the proverbial bat out of Hades on January the 1st. And companies had extraordinary, and they said, well, yeah, this is Mr. Trump. He's making it business friendly. He's deregulating. He's going to make us more, much better commercial space to do businesses, to make profits in. I can tell you now, most businesses, all those profits, all those gains, those valuation gains have been wiped out in the last 3 days. That's why I've been busy redrafting these slides that are coming up shortly. And you can probably redraft them in the next couple of days as well. So the new US administration has certainly shaken everything up. I mean, it's literally thrown the baby out with the bathwater, if I can use that expression. There's no holy cows here. So it's going to be a buckle up and see where we go. I think everybody sort of expected that. But the reaction in terms of the tariff, and if you go down to the bullet point there on tariffs, it was put on hold, markets went up. Yesterday, he says, no, it's coming, and now there's counter tariffs. And everybody, it's like a tit for tat. It's a bit like what's happening in the geopolitical space in Ukraine and the US. So it's leading to a lot of uncertainty in terms of where would we normally be if tariffs weren't in place. Now, where we normally would be is probably interest rates would be dominating. And that's what happened during the last 3 months of last year. It was all about interest rates. How many interest rate cuts are we going to get? Will that help people in debt? Obviously. Will it help companies who are carrying debt? Obviously. Certain sectors that are interest rate sensitive were going to do very, very well. And people started buying in because they were at depressed prices and attractive, valuation prices. So interest rates have sort of been pushed to the side now, while this momentum of tariffs just takes over, this whole noise of tariffs. But the two are connected intrinsically in terms of, and the Federal Reserve has come out and said it. Warren Buffett, who runs the CEO of Berkshire Hathaway, probably the world's most successful investor, wrote a scathing report. I can share it with people about the fact that tariffs are going to cause short-term problems, but in a longer term, 10 to 20 years, their effects are going to still be felt if this thing really gets heated up. And I think his nickname is his moniker is the Oracle of Omaha, where he lives. An oracle being a wise person, a sage individual. So a lot of people are looking at that. And the Federal Reserve said, look, if these tariffs are going to increase the prices to the US consumer, they're not going to be dropping interest rates because this could stoke inflation again. So it's all caught up together, and it's all very messy because, as I mentioned, it's a fast-moving sort of situation at the moment. Trends in earnings I've sort of discussed. I don't want to go into too much detail because that's a whole webinar in itself. But earnings have been knockout. I mean, as I mentioned, the earnings that we call it, companies are up on deck announcing what they did in 2024. They do it every quarter. So for the last quarter of 24, earnings have been stellar. They've been knocked out the park. But now, obviously, and that's where we should be focusing on the quality of a company's earnings. Are they good? How much are they making? How much, when you net off their costs, what are their profits? What's the profitability of the company? And some of these companies have now gone non-profit. And I'll show you one of them in one of the slides. So the geopolitical concerns are there. And I think one of the really important areas, which I think is dominating, and I suppose this is the high-level bullet point, is the EPU, the economic policy uncertainty. So Donald Trump is mercurial. He has a very complicated relationship with the press, I believe, and with his view on the world. I'm not going to dwell in psychoanalysis here, but the markets and investment analysts and gurus are not quite sure which way he's going to blow in terms of from 1 minute literally to the next. He could be sitting on TV like tonight he's making an important speech. It's effectively the State of the Union speech, but I think a lot of it's going to revolve around his behavior and his antics with Zelensky recently and with these tariffs and what it's causing. You must understand that big business in America is a very entrenched, vested interest in terms of what they are getting wiped off their balance sheets at the moment. So there's a lot going on behind the scenes. So he's very mercurial, and there's a lot of uncertainty into which way he's going to go. A lot of people are saying he's going crazy now. He's beating the sword on the shield, and he's going to let everything die down and see what falls off the tree. That may be one tactic. The other tactic is that if you look at one's, I won't say it's megalomania, but certainly if you start saying, well, Canada's the 51st state, Greenland will just buy it, the Gulf of Mexico now becomes called the Gulf of America, the Panama Canal must be ceded to America. There's certain things there that I think you've got to take with a pinch of salt, but it causes uncertainty. And the one thing, it's been drilled into me over the years and years that I've been involved in stockbroking or investment markets, is that the investment markets do not like uncertainty. Rather tell them the bad news. Say it's going to be 25% tariff. Don't ooh and ah and up and down, because what we've seen is everything going up and down, up and down, up and down. And we're unwilling, well, we are the passengers on that very bumpy ride. So that's kind of a bit of a doom and gloom scenario, where up until, literally 72 hours ago, Friday, things were looking quite positive in terms of maybe the tariffs were going to get stalled again. China seems to be having some influence and stimulus, and if you look at the Chinese market, it's coming right a little bit. So it was looking quite rosy, and here we go again. So it's a bit of a case of buckle up. Now, wherein lies the opportunity here? So if we may move to the next, past the next slide, because we've had a look at that. That's just we tend to forget. I said, lest we forget. So this is the one that I've had to change about 3 times in about 5 seconds, because the markets just move rapidly. I mean, I can tell you now, if I look at my screens, Intel's down even more, Microsoft's down, not by much, but Nvidia's off, Tesla's off. So these are the one-day performances. So I've broken it to one-day performance, which is, it's really the day traders. Your 7-day performance, which is week to week, 90-day, 30-day performance, and 90-day and 1 year. I generally look at 5 years, okay? And 5 years actually works quite well with a structured note because we're in a 4-year term. But these are different times. And the times here is that is that the opportunity now where these companies are coming off in value quite severely? I mentioned correction, I mentioned pullbacks, and they're painful. They happen all the time. We don't like them, but they're a fact of life. We see them all the time. What's happening now is that there's corrections and pullbacks all over the place through all sectors, not just this sector of tech. It's happening everywhere. Walmart came out, the CEO of Walmart came out and said, inflation is going to be stoked and prices are going to go up for the American consumer because of these tariffs, because of some of the corn imports, et cetera, from China. So it's all to play for. We can't analyze everything. We can't be experts in everything. But you can see there that, if you move across maybe to the 30-day, Intel's had a fantastic little run, but over time, Intel has been absolutely crucified over the last year and a half. It's a company that could actually be broken up. It's fallen out of the Dow because the darling. It's got huge government backing, though. I don't think they want to see Intel be split up and sold to two competitors, one in Taiwan and one in Holland. And that's where the price came in. There was a lot of movement there. Somebody said to me, why 17% when everything's showing negative? I said, well, there's speculation around this business that may get broken up and value unlocked. But overall, you can see over 1 year performance is down 50%. So it's just a short-term blip. But if you got to think about Intel, if you take that line and analyze it, it's down 50%. Could it lose another 50%? Possibly. It could go to zero, I guess. Obviously, if it got broken up and sold and delisted, it would fall out of the basket. Simple as that. I invest in this particular reference basket. We can talk about that later if there are questions. Microsoft has had less of the impact. If you look at the numbers there, they're not as severe. Over 1 year, it's only down 6%. And you can see their numbers are more aggregated to the massive company that it is. NVIDIA, that's the darling. They had their results 2 weeks ago. They had knockout results from Q4. They went way past all the estimate earnings. But Jensen Huang, their CEO, said, look, guys, let's be reasonable. We can't quarter on quarter just keep blowing things out the water. There are going to be times where we need to spend more money. We need to consolidate. They're coming with a whole new range of chips, etc., the Blackwell range. And they've got competition. And now they've got tariffs to deal with. And that's why they're seeing a steep decline. I mean, NVIDIA were 8% off yesterday. I'm looking at it now. Okay, they're not too bad at the moment. They're 1.45 off since started trading. Microsoft's just off about 1%. Tesla 6, Intel 7 down. So it's all happening on the day-to-day basis. You mustn't get too caught up in that. You've got to look at the longer-term picture. But what it means is that suddenly we're seeing these pullbacks turn into corrections. In other words, these are quality companies. I mean, NVIDIA is still the largest company in the world. Like with Apple, the Amazons, the Microsofts, those tech companies. Tesla lost its billion, I beg your pardon, it lost its $1 trillion crown last week when it slipped to 972. It's probably gone further down. It was part of the trillion cap club. So this is what can happen to a company, but one has to look at the specifics of the company. So I'll touch on Tesla because I had a really interesting discussion with somebody at Goldman Sachs this afternoon in London. And they did a survey in London, and I don't know how they do their surveys. They walk around in the street and they say, do you own a car? I'm not quite sure on the parameters and the demographic that they chose, but 59% of the people that were interviewed were asked the question, would you buy a Tesla? And if you don't buy Tesla, is it because of Elon Musk's behavior, either in supporting the far right in Germany or his antics in Doge in the United States and his general space he occupies as an individual? And 59% of the answers came back and said we wouldn't buy it because of him directly. Now that's not a great thing to have when your CEO, he's always been flamboyant and he's always been outrageous and he's always been the rest of it, Pretoria Boyke. But his involvement in politics, a lot of analysts are saying, might take away his concentration, might take away, the involvement, the purpose and passion of Tesla. That's one point. If one looks in a deep dive in Tesla, and I've done a deep dive into Tesla, Tesla is pivoting away from electric cars. How's that for a statement? They're still going to produce electric cars. Their sales figures are down pretty much in a lot of areas, Europe, China. and a few other places, America, because they don't offer the freebies that all the Chinese cars offer. But that might be a problem now because the Chinese have got tariffs on them and their cars aren't going to be allowed into America. But when I say they're pivoting away from electric cars, I'll refine that. They're still going to be an electric car manufacturer, but they are moving into artificial intelligence and robotics. We've all heard about their robotic driver, your autonomous driver, robo-taxis, robo-vans, you name it. Where basically we step into the Blade Runner world where cars don't even have steering wheels. I don't know why they put steering wheels in cars, because these automatic cars, because you don't need it. It's another cost that you could take out. But that's where they are moving to, and that's possibly the next wave in terms of electric vehicles. Everybody's gearing for that, and it is coming because those vehicles, you do see them, they do drive around. So is that going to be Tesla's new earnings stream? And you'll see some of the analysts are looking at that very closely and saying the Tesla business is a legacy business. It's new ideas. Once they come to fruition, once they come and produce earnings, that's always key. It's earnings. It's all very well to have an idea. You've got to, it's like having potential. You don't want permanent potential. You want delivery. You want a reality, a realism. So that is, if you look at that, there's opportunity in terms of these companies where they've lost valuation. Now this, as I mentioned, it's a classical term in investing. It's called buying the dip. It's got to be taken with a pinch of salt because there's a lot that goes into here. And this particular slide does not tell you everything in terms of, okay, this is how you buy the dip. But essentially, it's looking at a valuation that doesn't appear to be in sync with what everybody feels it's actually worth, okay? But you have to understand, as I mentioned in the second paragraph, what are the reasons for that dip? You have to have a look at some technical indicators in terms of the metrics, in terms of some of the quantitative and qualitative issues that analysts will look at, managing the risks, having disciplined approach. If things go up and down, you just got to put your head down and keep going. So there's a lot where market buyers, professional investors, the Ray Dalios of this world, the Berkshire Hathaways of this world, you name it, they will look for opportunities where there are quality companies that have been disturbed by influences of which they have no control, but they are still quality businesses. They're not sitting on piles and piles of debt. They're not sitting on a leaderless company. Okay, Intel is one at the moment. They need to appoint a new CEO because Pat Gelsinger basically he said he retired, but he was actually fired last year. But generally speaking, the analytical, the quantitative and quality of analyzing a company will lead an investment individual or a committee to say, there's opportunity at a premium that we are not going to get. These are prices that we last saw maybe 2 or 3 years ago. It's a bit like what happened in 2020. You could buy companies that were at valuations that were wow, because of that huge fall down the mine shaft with COVID. So that's what's called the so-called buying the dip. Now, does buying the dip now, is it appropriate? Well, you have to look at your own portfolio and you have to look at what you're actually doing, because you might say there's all this noise that Andrew's gone on about and I'm hearing it in the paper and I'm watching TV and I'm seeing this and that and the next thing, social media, I'm just going to sit tight. And that's perfectly, it's your call at the end of the day after your due diligence. But there will be investors who say, wow, NVIDIA is an absolutely blue chip company. It'll get through this. Its sales figures are strong. I mean, if you look at their sales figures out 3 years, their order books are full. Absolutely. Their manufacturing is up to speed. So you look at issues that are not going to actually change the business. There's a nice saying, if I can find it, there are two important requisites in buying the dip. It's actually on the next slide, but I'll tell you now. A sharp decline in stock prices and a strong indication that they're going to rise again. So this company is not going to disappear. Okay, it's going to come. It's part of the fabric. It's part of everybody's portfolios. It's part of our lives. We need it. So let's move to the next slide, which is some of the these are 4 large global stocks. And if you look at those, I mean, I can tell you now. Well, as of I don't know, but as of probably yesterday, NVIDIA were probably the second largest company after Apple. Microsoft, I think, were third. Tesla, I think, was about 9th or 10th, and Intel was a lot way down in terms of the pecking order. when in fact it used to be a a Dow component, one of the 30th largest companies in the US market. But have a look there. I mean, those prices, 0303. I mean, those prices have all changed today. They're all gone further into negative, no, not negative territory, but further down in terms of valuation. Your 1 year returns. Okay, so all these figures will be changing, obviously stochastically as you go across because of what's happening live. But if you had to put a stick in the mud and say, okay, as of close of business last night, 3rd of March, 1 year return from NVIDIA, still good, 33%. Although, they on the second they lost 8.8% in 1 day. So they obviously were doing much better, but these are all now starting to degrade a little bit. Have a look at the red column. Okay, so this was as of the 3rd of the 3rd. This is not a set in stone. The analysts know everything. The analysts get it wrong. Analysts often promote a certain company for their own reasons. But this is a consensus of 32 Wall Street. This is an extract from 32 Wall Street analysts. That is published. You can go and read this. And as at yesterday, given the swirling rumors that these tariffs, which is the big talking point, were going to be implemented, they still had those quite lofty targets in terms of where they would be in 1 year's time. So these, this is 12 months out. Now, a heck of a lot can happen. You see what's happened in 72 hours. So, I always say take it with a pinch of salt, but it gives you an understanding of the background fabric to this is that they've researched these companies to a degree that we cannot. They've got teams. I mean, Goldman's has probably got 50, 60 analysts looking at one company. Okay, and that's on the qualitative side. Then there'll be the quantitative guys who do the metrics. They'll have company visits. They will know things that we will never get, proprietary information on. So it gives you a sense of more an educated. Okay, so these companies are good companies. If they can get through this longer term, there's a bright future for them. They're not going to fall off the edge of the table and never be heard of again. Okay. I'll just run through briefly so we get an understanding. So we've got 1 year return, last price. MCAP is their market cap. So that's basically what the company is worth. Okay. It's basically the total value of the company representing, the size of its business. Okay. So these 3 trillion, you can see 942 Tesla fell out of bed there. It fell out of the club. The targets and the valuations are quite important. So that's really one of the metrics, if I can call it that. So it's one of the financial analytical tools, which is almost gospel in an analyst's mind, in a stockbroker's mind, in a asset manager, in a unit trust manager, in a portfolio manager. They will all understand valuations. Now, technology stocks have done extraordinarily well in terms of, if we just go back to that previous slide. So I just need to finish that off. Beep, thank you. I won't be too much longer. But valuations are important because the valuation basically means, and you've got these PE, that's price earnings, okay, the price of the share versus the earnings of the company, and you get a number, 41.8x times, okay. So, what does that actually mean in English? And I've got my own way of explaining it, but I came across something and I actually printed it out here. It says here, let's say it's got a ratio of 15. Okay, here let's take NVIDIA, 41.8. Let's say it had a ratio of 41.8. It would mean an investor is prepared to pay $41.8 for every $1 of the company's earnings. So you're prepared to pay a big premium to get your hands on these shares. Okay, and a lot of people have said those valuations have been stretched beyond what is actually reasonable. So if you look at, they're all high. And tech has been very, very high. A safe price earnings ratio, big company, you're looking at about 10, somewhere around there. These are high, but they've been consistently high for the last 5 years, and they keep producing. The last one, Intel, there's not a typo there. It says PS, not PE. That's price to sales. And you can't do a price earnings ratio if you're unprofitable. It's an ugly word, but Intel is unprofitable at the moment. So the way that's done is that they look at the price of the company versus the sales books. I mentioned NVIDIA's sales books are for 3 years. So they look at that and they do an equation and they work out what the price sales is. It's quite accurate because unless you're lying in your sales books and your sales orders, And well, then then there's a big major problem with your auditors and the whole governance structure and risk. But basically, I'm trying to give an indication of these companies have always been highly rated in terms of what people are prepared to pay for them. And suddenly, those price earnings might get a little stretched even further because valuations are coming down, and you haven't got such a big number to divide into your earnings, which might also be coming down. So, yeah, and there's my statement. The two requisites for buying this dip. Are you buying value? Are you buying it at the right time? How long do you have to sit? A structured note, you've got 4 years to ride this dip and paying 4% per quarter. So therein lies the opportunity. Some clients will buy the dip because they're going to get paid a dividend, or they're just prepared to buy it because they know long-term they're buying value. So fantastic worldwide investment company, Alan Gray, they're known as value investors. They'll be looking at companies where they're seeing value opportunities, where quality companies have been affected, possibly in the short term, but they're going to get through it. And by the time they unlock that value, they'll exit at a great profit. So yeah, here are the ratings. And as I said, take this with a pinch of salt because this could change. I'll just give you a little bit of, consensus rating right in the middle probably is the easiest to understand. What are the guys saying? Reduce, buy, accumulate, hold, sell. Okay. I don't see any sells there, but that could change tomorrow. As I said, it's a snapshot. It's not set in stone for the next 12 months. These things do change. But interestingly, as at yesterday, at the start of business this morning, close of business last night, they also give a sort of consensus price target. They don't just sort of suck their fingers and their thumbs. They've got these massive teams that get paid an awful amount of money to actually say, well, what do you think the companies actually should, where should it be? What is the fair value of this company? Where should it be trading? How much are they under? How much upside is there? How much are they discounted because of these extraneous factors? And certainly, probably Tesla has got the biggest problem in terms of Musk as a personality. The others are faceless in terms of they carry on doing their business. He's a bit of a wild card in terms of Tesla. And you can see he's probably got the lowest upside. They don't believe there's huge amounts of upside at the moment because Tesla's in this almost pivoting. They're going into a new trend, new space of, as I mentioned, the AI, robotics, etc. But in the meantime, if one had to overlay this in terms of, okay, if I had to invest in a note which had these companies in, okay, as the analysts at this moment in time, this should be quite good because the terms and conditions, which we'll go through shortly, I think after the slide we start, basically say that the share prices should move upwards in the next 12 months. And the terms and conditions of this is that as long as they don't go below 50%, I'll get paid 4% every quarter. Thanks for coming. 16% per annum. Very tidy. And there's an opportunity to actually exit on a early maturity. It's from 6 months and quarterly thereafter. Should those, should certain terms and conditions be met? They just have to be 95% of the starting price. Now, we don't know what the starting price is because the starting price will only be determined once the raise closes, and that's in the next slide. So maybe we should go to that slide, but I've tried to give you a flair and a feeling for the fact that quality companies, if somebody said to you, you can go buy Apple tomorrow at half its price, you think about these things. I've tried to give you a more theoretical, introduction into it. And obviously with all the noise, you can get distracted and say, "Whoa, things are a bit hairy at the moment. Let me sit tight." Absolutely fine. So let's have a gander at the sort of terms. Chad normally does this. He's probably ordering chicken or beef now, as Joe said. He's 30,000 feet in the air. Moody's, Fitch, and S&P rates SocGen. I think it's the 14th largest investment bank in the world now. As a globally systemic important bank, it's an A-rated tier 1 bank. So it's a big bank. We've had a long history with them. They do their homework very diligently because they've got to write this guarantee off their balance sheet. So their risk and compliance and bean counters and investment management teams have looked at this thing very carefully. The coupon is very attractive. I would suggest in US dollars, paid quarterly. It's a conditional coupon. In other words, it's not fixed income. It doesn't get paid irrespective of what's happening in the market. It's conditional on the behaviors and the returns of those 4 companies that we've referenced. And the term is a maximum of 4 years, so it will end at 4 years, but it can obviously finish earlier if the so-called autocall trigger, which we'll get to, is triggered. and that can happen from 6 months onwards, and quarterly thereafter. The income trigger is 60%. So in other words, once we establish what the price is, and it's a falling price at the moment, so it's the entry level point is becoming perhaps more and more attractive because of the valuations are lower, but it'll be 60%. So let's say, for example, one of the shares is valued at 100. We only have to achieve 60 to have, if it doesn't fall below $60. In other words, we've got a 40% degradation allowance, which is quite handy, especially if some of these companies are already degraded quite substantially, adding on another bit. So therein lies the opportunity perhaps for a client to say, does that fit in with my way of thinking? Okay. I mentioned the Autocall trigger, which is really, and this is all going to be graphically explained much better than what I'm doing shortly. But the Autocall is basically, it allows you to exit the contract if all the shares have satisfied the T's and C's. Now, the T's and C's is something called a knockout. The knockout being is that some notes, all 4 shares have to be above that 95%. It's a 95% of initial value if you read there. They all 4 have to be above that level at the same time, okay, for it to happen. In this instance, if 1 or 2 or 3 are above, those 3 are basically knocked out. They're taken care of. They get a tick box, and we just have to wait for the one that hasn't. So they can basically auto call in principle independently of each other. And once the last one has done that, it ends. So it's sort of a building, accumulating process. The reference basket we've spoken about. There's obviously more detail in the rationale as well in terms of some of the metrics. Capital protection, we've got, I would believe, strong protection here, down to 50%. So wherever those shares start at, with all this drama coming into the market, we've got another 50% for capital protection at the end of term. So capital protection is important. So if this doesn't auto call, in other words, if it doesn't mature early and it runs to the 4-year period, the full term, then all those 4 shares need to be above the 50% level for full capital be returned. Plus, you'll enjoy the coupons, obviously. Availability, normally, as normal, we have a consignment that the bank has given to us, or the 19th of March, which comes first, and there's the subscription level is at 10,000. So that's really the granular stuff, and I think perhaps pictorially now you'll get a much better picture, and some of you will have seen this because we have had these knockouts before, and we have had tech before. So it's an exciting product, and it's exciting times. I keep thinking about 2020 when Chad and I started the business. We started in 2019, and the first investments we started doing around about, we did some just before, and then we did a swathe just after June, July, August, because the banks weren't issuing. They didn't know where things were going in March 2020. They were terrified the war was going to end. But when we got in, I said, we're looking at quality companies. In fact, we had NVIDIA back then. I think it was at about $12. So we did a note with NVIDIA. But the valuations of quality companies, I said, long term, this is going to rebound. And I certainly believe, if you have to ask me, I was asked this afternoon, it's my own personal opinion. It's not a advice or a suggestion. They said, what do you think Donald Trump's going to do? And I said, I think there will be some sanity in terms of, I think one of his most important picks, he's been very quiet at the moment. He has a pick like who's going to be my attorney general, who's going to be this, that, the next thing, the important roles, is his treasury secretary. And his treasury secretary is an ex-hedge fund manager, sort of Wall Street titan. He knows what's going to be happening, and he's clued in to the savvy businessman, and they're going to be squeaking a little bit at some point. So I think there's going to be a period where there's flexing of muscle. There's going to be some noise and some smoke and some drama, but I think longer term quality will see you through. And I said it to clients back in 2020. I said, keep fiscal discipline. Don't sell at the bottom. Keep your fiscal. You've got quality companies. They will see you through. And it's exactly what happened. So maybe without preaching too much, we can go to the next slide. And I think that's for you to take us through, Joel.
Cool. So what I'm going to do is actually run through the workings of the product. Thank you, Andrew, for all of that. It's always good to hear all the insight because, again, just to filter out all the noise, everyone gets into panic stations. So let's just start with the workings of the note and the standard features that we include to help mitigate the risk and protect capital. In the next slide, I'm going to go through the additional feature that Andrew mentioned, the knockout feature. But for now, I'm going to just start with the basics of how the income note works. So basically, for those that are aware, the value of the stocks in the underlying basket are going to be measured on the strike date, which can also be referred to as the start, initial, or the strike value. Once the note starts, we are going to observe the value of each of those stocks in the underlying basket at each quarter, and then that value will be compared to their start price. If all of their values are above the income trigger, the coupons are going to pay out and reflect a day or two later on your platform. And then you're going to be receiving an email from us letting you know what the outcome of that observation was. In this instance, as Andrew said, the income trigger of this note is set at 60%. And as long as the stocks are remaining within the green area on the graph, your income is going to flow. We've also included the memory feature, just in case any of those stocks do dip below the income trigger. This is a fantastic feature in volatile times, and we have used it well, in every income note we include it. And over the last period of time, we have had notes that have gone into the memory feature and come back out of the memory feature. What this means is that if any of the stocks do fall below the income trigger, the memory feature is going to hold onto the coupon or coupons until the next time that the stocks are above the income trigger. It's then going to look back and pay out the coupon that's due plus any missed coupons. Next, we've got the Autocall feature, which we've spoken about, which is that early maturity, and that is set at 95% of the start price. So you even have a 5% degradation there. This is the opportunity for that note to mature early. In this note in particular, the Autocall feature goes live from 6 months or in the second quarter. Once all of the underlyings have breached the Autocall trigger, the note's going to mature. Investors will then receive their coupon plus all of their capital back, and the note's going to close. There is an opportunity to autocall each quarter from 6 months, as I said, but we've also added an additional feature to support the autocall, which I'm going to go into. In the event that the note doesn't autocall or mature early on any of the observations from that 6-month point, your note will run the full term. And there we've included the deep capital protection barrier. The capital protection is really important for us. As with most of our notes, we set it at 50%. And that means that even if the underlying stocks drop by 50% of their start value, and as Andrew mentioned earlier, they've already come off quite a bit. So it's an even further 50% that they can go. You will still receive your full capital back. And if the stocks drop below the protection barrier, your capital will then be returned on a one-to-one basis. So just moving on to the knockout trigger, it's quite a busy slide. As mentioned, the knockout trigger, the underlyings do not have to be above the autocall trigger on the same observation date. So if on any quarterly observation date, starting from that 6-month level, any of the underlyings are at or above the autocall, the underlying will be knocked out. And then when the last underlying is knocked out, the note will have autocalled and it matures early. If the early maturity occurs, your full capital, as I said again, is returned and your investment's going to end. Because the underlyings can knock out in different quarters, it allows for much more flexibility in achieving the autocall trigger requirement for each of those companies. Then once achieved, that successful knockout, it doesn't have to be repeated again. It's already got its tick in the box. For those of you that know, our best page of the important dates page. We love this page because in a single glance, you can see the observation dates, the level that you need to reach for the income trigger, the autocall knockout trigger level that you need to achieve, as well as the payment date that those coupons will be paid to your platform. And then they reflect a day or two later. You can also see the capital protection barrier and the final observation if there is no order call. So this is a really great page to keep handy, because then you know you can put it in your diary what's going on, and then we report obviously quarterly after that. Remember that when the issuer signs off a structured note, they're going to be holding it onto on their balance sheets. So they will be comfortable that they are able to cover the cost of funding, i.e. the returns that they're going to be paying you, and still make a healthy profit for themselves. They establish this through extensive research on the sector, selected stocks, etc. And then as the investor, you need to take a view on the strength of the bank, because they are the ones that are going to need to meet their commitments. And of course, the underlying stocks supported by the various features and protections that have been included for a successful outcome for the note. For new people on the session, all you need to access any Cashbox Global Structured Note is an online trading platform. It's also called a custodial platform, and that holds the contract for you on your behalf. You can't invest via a bank account. We are platform agnostic, but if you do need guidance, just drop us an email. With those that do already have a platform, you would let us know that you would like to participate, and then we would provide you with the ISIN number, which is that unique identifier for the particular note. While you can always draw a report from your trading platform, we provide quarterly reporting to keep you informed about your investment. And if you would like a refresher on structured notes, we're happy to provide any kind of training or support, because again, it is really important for us that our investors understand how their investment works. Remember, the closing date for your funds to be cleared and your instruction to be issued to your trading platform is the 19th of March. If you don't plan ahead, you're not going to make it in time. And as Andrew said, there is always limited capacity.